So I want to start off by talking about something that Marianne Tighe said back in December. She made a pronouncement that seemed a little strange at the time. She said that New York needed new office buildings, which seemed crazy. It was after COVID, we were teetering on the edge of the urban doom loop. They were talking about putting urban farms in skyscrapers. And, things have really gotten tighter. And fast forward 6 months after she said that, we're really seeing a strong office market that's not only showing green shoots, but really starting to bloom. And this is really good news for New York. There's some countervailing trends. We're looking at tariffs. We're looking at concerns about, weakness in the office market for Class C still, but these are some good times, and I want to get into it on stage and just introduce these guys real quick. They mostly don't need an introduction, but I'm going to do it anyway. Marianne Tighe, the most powerful woman in New York real estate, head of CBRE's tri-state region, 4,000 employees. You got John Santora, head of WeWork, the new CEO. And I just want to point out that in many ways, John is the anti-Adam Newman. Adam Newman, would do yoga and drink kombucha, and John is from Staten Island and has a mustache, so he's really charting a new course for the company, which is exciting to see. And then we got Richard Coles from Vanbarton. He's really led the way on some of the Office-to-resi conversions. Pearl Street was one of the first projects out of the gate with a conversion trend. So he also owns office space, so he's kind of on both sides of the coin here. But I want to get into some of the positivity we're seeing in the office market right now. Marianne, I want to start with you. JP Morgan, they recently said that there's a 60% chance of recession. Everybody's worried about tariffs, but it doesn't seem like that in the office market now. I mean, what are you seeing?
It doesn't. I have to say, I think that we've turned the corner in a definitive way. And I think what's been interesting is to watch the foundational group. When you think about who's always led the way for us, it's financial service firms, it's been law firms, it's been Midtown. All of that has held true. And what we're seeing is the financial services industry is booming in New York. Mm-hmm. And we've turned this corner without the tech companies really coming back in force. Only now we're beginning to see the tech companies coming back. So I think we're in for a very strong 25, but I think we're in for an even stronger 26, 27.
And this is crazy because, it's been 5 years since COVID, 5 years since all this started to happen in the office market. Now, there's a countervailing devil's advocate point of view, and, Marianne benefits from certainty, among tenants. John here benefits from uncertainty among tenants. So I want to hear what you think about tariffs, and, you're saying it may be not quite as rosy as, some of the news we're seeing right now.
So it's not that we only benefit from uncertainty. We benefit giving, each company or large corporations need a piece of their portfolio that flexes, right? And we chatted about it earlier, 20% of a portfolio flexing. And for us now with the tariffs, we are seeing a little bit of that hesitation, not on the big scale, big, large deals, but on the mid-sized deals, mm-hmm. We're seeing a hesitation. Who's ready for a small firm to commit $30, $40 million between build-outs and everything else and commit for 15 years? We can provide them that flexibility. And it's not to say that traditional leases aren't part of the equation.
Right.
It's a combination of both. I think that firms need a piece of their real estate is flex, piece of real estate is probably owned, and then there's the traditional leases. The combination of the three make a good equation.
So this is really rubber meets the road. Is the tariff psychological at this point, or are you actually seeing impact?
We're seeing a little bit of it. My view is this, forgetting about the reason for the tariffs. This pause, everybody talks about 90 days. It's not 90 days. You're not going to change a supply chain in 90 days. That supply chain has been built over decades. So when Apple says it's going to make new phones in India, right, that doesn't happen in a year's period of time. It's 3 or 4 years or 5 years to build the factories, hire the people, get the equipment, and put out the first iPhone out of India. So New York is New York. It's special. It will always grow. The office market is the best office market in the world. But when we start to look at the impact of the tariffs, I think it impacts other cities in a greater way.
And go ahead, Marianne.
I just want to make a comment about WeWork and about, we always think about WeWork as being something, as in the case of Amazon, that allows for a flexible portion of the portfolio. But increasingly, on the agent side representing landlords, we're telling landlords that if the building is, call it 1.5 million square feet or greater, you better have some co-working space in the building because you need it on so many levels. I'm thinking, for example, of the Christie's deal we just did, where they're remaining in place and made a commitment until 2050 to stay at Rockefeller Center. Essential was that Rock Center had co-working space, which will function as swing space so that they can move in and out of their almost 400,000 square feet over a period of years and rebuild. You need that if you have a building of scale. So it's important both on the tenant and on the landlord
And
side.
Absolutely.
full disclosure, CBRE recently bought Industrious, which does have
There you go.
co-working space. So you guys were competing for decades at Cushman and CBRE, and now you're competing in the co-working.
Aren't we lucky to have a market as big as it is?
Yeah.
Because there's room for both.
But I want Richard to be the tiebreaker here. Richard, are you bearish or bullish, about the forward-looking prognostications?
So I think I'm very bullish on co-working for the reasons Marianne mentioned, for all the functionality that John had mentioned. But not all cities are recovering at the pace of New York City. So when we look at co-working, it's outperforming in Manhattan, but other markets don't have the corporate leadership, the municipal leadership, and the street level activity that New York does.
Right.
And therefore the recovery could be 18, 24 months behind where New York is. So
Right.
it does vary city by city.
And where does New York rank on the hierarchy? I mean, you have properties in 33 cities. You have an office in San Francisco and New York. I mean, obviously San Francisco was just, really, really hard hit. Where does New York rank in terms of recovery?
The best.
The best? Wow.
The best.
Wow.
Again, it comes back to the corporate leadership. The decisions we're talking about, the landscape we're talking about today is a function of decisions that were made 18, 24 months ago. And it may have been unpopular, but when corporate leaders said back to the office, what that did was it primed the pump and it created that momentum that New York City needed to make the streets safer, to create the street level activity. Retail came back or is coming back. And cities are in many respects 12, 18 months behind New York.
Yeah. Because it was interesting. I mean, I think the low point for New York, and this is a little bit more on the investment sales side, during COVID, I think there was one quarter where New York was 7th in the country in terms of investment sales. And it was like, wow, that's not a good sign. Miami's getting all the attention. I mean, do you see a recovery on the investment sales side too?
I must point out that every time we talk about Miami getting all the attention, do we all appreciate how small that market is? I mean, we want it to flourish, and maybe in 100 years, we might be talking about something that was a serious contender. But if you're looking for a real population where you can find your employee base, that's why New York flourishes at the end of the day, because of the population that's here and wants to be here.
Yeah.
And I'll just add on to what Marianne said. It grabs the headlines when Ken Griffin moves to Miami for tax purposes. But there are upwards of 1 million people who've moved to New York because this is where they want to be. Yeah. And they're not worried about tax estate planning. And they're here because it's New York City.
Right. And, not to knock Miami, but like how many, there's no MIT in Miami. There's not as many doctorates, it's an unavoidable fact.
I mean, it's talent, it's culture, it's infrastructure. We have it all here in New York, and that's why New York always rises to the top. But the other markets are, as we were talking earlier about San Francisco, it's starting to come back. They're seeing the green shoots. AI is driving a lot of that, but it has a long way to go, and a lot of that is around safety and security.
Yeah. And I want to ask you, Marianne, we started out talking about new office buildings getting built. What do you think are going to be the biggest beneficiaries in terms of neighborhoods? Is it Midtown East? Is it Hudson Yards? And what do you think is going to be the next ones kind of out of the ground, which seemed inconceivable, a couple of years ago?
So the thing you have to ask yourself is, where are the sites? Where can you make sites? I can tell you that I can envision sites in Midtown. I think we're going to see, obviously, Gary Barnett's already coming out of the ground. He's going to hit the market timing-wise just perfectly. I'm hoping for 175 Park as well. I'm certainly hoping for Boston Properties on Madison as well. But I can tell you that we're going to see, hopefully, this happening in not only in Hudson Yards, but downtown as well.
Yeah, and the biggest one was Deloitte taking 800,000 square feet in 70 Hudson Yards. Biggest project since COVID started in terms of office projects. Like, what is Related doing right in terms of, I mean, they did beat out some other sites there.
Well, you know, the interesting thing is the speed with which Related is prepared to execute. So they had a clear site, fully entitled, with a design, and they were able to actually demonstrate that they could meet the expiration date at 30 Rock, and they were able to make it happen. They made a viable choice, whereas pretty much everything else,
Yeah.
you know, if you looked around, it's going to be 30, 31, 32 before those buildings can happen. That was a huge selling point.
Not to knock the other developers, but they are such a well-oiled giant machine at this point that it's just, to your point about execution.
I mean, I would look at Penn Station, what's happened around there, what Veneto has done. It's been a fabulous project as well, and connecting to Brookfield and then over to Hudson Yards. But if I was going to look out 10 or 15 years, I think Park Avenue just going to be at the absolute height again. Why wouldn't you want to be on Park Avenue?
Yeah, where, as you mentioned, you'll start to see more $300 square foot rents, maybe one day $400 a square foot. We'll see.
No, 300, we're comfortable there.
Yeah. John, I wanted to ask you, we started out, you know, talking about how you took the helm, you know, post Adam Newman. What is kind of your vision for the vibe of WeWork? It had such a very specific vibe back in the day. Where do you want to position it relative to, you know, you don't want it to be that, you don't want it to be, you know, a Regis, which is kind of, you know, a little bit more on the boring side of things, I think, for co-working space. Like what's the sweet spot?
Yeah, I think if you look at our firm today, it's maturing and continuing to mature. So it's great office space, but great community and hospitality services. And one of the things we've done recently is we've engaged the Ritz-Carlton to handle and train our teams so that when you come in, you get that feeling of welcomeness, community, so the ability to you know, enjoy your space and create a great environment around it. I think I know that we're seeing more of the enterprise product. A lot has been written around Amazon and all the work we've done here in New York around Amazon. There's been a lot of other deals. We've done a few other announcements that'll get made in the next couple of weeks. So that enterprise client as well, where we build for them,
Yeah.
but they enjoy the whole community aspect around it.
Marianne had questions about how that works, because Amazon can do its own deals, but then you can do deals where you're leasing the space for Amazon. Like, why doesn't the landlord just go direct to Amazon? You know, what's the distinction there? What's the dividing line between a deal Amazon will do on its own versus, you know, something you'll do for them, lease the space, and then they take it?
So there's a couple of things. The most important thing is speed to market, right? We have an agreement with Amazon. We have a membership agreement that has all the terms, conditions, and everything else. We now have to just fill in those blanks around the location and the cost and so forth. Our negotiations with the landlord, or in some cases it's a sublease, doesn't require the same level of legalese and all the other stuff around the lease that would take, you know, that would be a 15-year deal, locking somebody in for 10 or 15 years between a major corporation. We're talking about Amazon here, Amazon and say Renato, or Amazon and Related. That lease, that structure is a lot more complicated than a 2-year deal with 2 one-year options.
And the key thing is that Amazon just doesn't want to do the deal direct with the landlord. So what's the landlord going to say, right?
That's the key. That's the other key, is they don't want to be engaged with the landlord at that level. They want us to do it. They want us to provide all the services that go with it.
Right. Richard, you said something when we talked earlier about WeWork being a threat to the integrity or structure of your business. Explain.
Well, our office business is predicated on getting a term from the occupant. In a perfect world, you get 10 years, or you compromise, you might get 7. And for a smaller space, okay, you'll take 5. Then in comes this long-haired Pied Piper who says, no, 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 no. You want 30 days? We'll give you 30 days. And became overnight, at one point, one of the largest landlords in New York.
I think the biggest landlord at one point.
At one point, and disintermediated what had been our bread and butter, which is saying to the tenant, you have to take term, you have to take duration. And a lot of tenants just don't know where they're going to be 7-10 years from now.
Right.
So I hate to say it, it's a real deficiency for the conventional owner-tenant relationship.
And, I think WeWork was also pre-COVID, a sign of weakness in the office market where landlords were filling that space with a WeWork, and it was kind of obscuring, some vulnerability in the market that was there, but kind of could be covered up. And then WeWork, went through the bankruptcy, which you arrived after.
Can I just comment though? I think John said it right before. I want to say this correctly. The process of making real estate decisions is not the core business of any significant firm unless it's a real estate firm. Consequently, they don't really want to do it that often on a major scale. I can't tell you how many CEOs have said to me, I'm doing this once in my time as CEO. What John said is right. It really works for a component of the portfolio. But if you think of the core portfolio and all the decisions a CEO and the whole C-suite need to make in order to make a new headquarters or to even to choose to remain and renovate a headquarters, that is such a distraction to the core business. They don't want to do it that often.
Right.
So what you provide is a valve in a sense. They can tinker with what the amount of commitment is. I don't think we're in jeopardy.
No, by the way, the CEO not only has to make the decision of where to go, but then they're confronted with having to create an environment that their employees want to come back to. And no, you've done a great job doing that. And CEOs are saying, oh, wait a minute, we have to have a what bar? A kombucha bar?
Right.
We sell, deodorant. That's not what we do.
Yeah.
I'm just going to let them talk. Help for me. It's great.
But you're kind of advocating an organic, use of flexible space, which makes sense. It was these big giant Jenga pieces before that you couldn't, really assemble easily, right? But WeWork allows for some of that.
There's one other piece that we haven't talked about, and that's the capital spend. And what I was surprised about in taking this role is how many large firms that have great finances and everything else have asked us to put the capital in to do the build out for them because they want to pay one bill and it's an operating lease, not a capital expense for them. And in asking the questions and digging deeper, they'll say when they go to their CFO, they're competing against all the other areas of their company, research, new products, new development. Oh, real estate, you're just a cost.
Right.
So it takes so much longer to get that done that way. Where if we provide the capital and do the build out, it happens really
you
quick.
You avoid that internal company red tape. Richard, I want to ask you, obviously, like we discussed, you've been doing office-to-resi conversions. If the office market gets hotter, does that increase valuations and then make it harder to do conversions? Is there a limited window for these conversions, or you think there's still going to be a lot of room to run?
We've been doing office resi conversions now for 2 decades, and the number of them has increased exponentially. It's been dramatic. So I have to believe it's a cyclical industry and the numbers will ebb at some point. But there is still a tale of two cities where there's a big part of the office inventory in our city and cities around the country that is structurally obsolete. And it doesn't make sense for the landlords to invest the necessary capital in the base building components of the building, let alone re-tenant the building, commissions, free rent, tenant improvement allowance, and then try and make a profit on it in a fairly high interest rate environment.
Right.
So I think there is going to be probably another 4 to 7 years of that sort of opportunity set. The great thing is the city of New York has really been very encouraging. They've passed some great regulations and subsidy programs. So where it was previously really concentrated in the financial district, now we're doing it elsewhere in the city.
Yeah. No, I mean, it seems a year out from those city and state measures getting passed, I mean, it actually is making a difference in terms of development. One of the big ones for conversions is they're all 4 and 500, I don't know why, but the 467M, which requires you to have a quarter of your building affordable. Are you using that? And I also had a question, like, if you are using that, you're going to sell these rental properties at some point. Does that make it more complicated? Or how are you kind of approaching your exit for some of these?
I did the second part of your question first. I think there's a history in this city of liquidity in any type of kind of rent regulatory inventory. And yes, we are absolutely using it. It's a great program. Mm-hmm. The city really got it right. And I think you're going to see it being used more and more.
Yeah. And how about just, we're speaking about Class C properties and, some of the distressed properties, there's been the general extend and pretend kind of approach that banks have had. Do you see any of these more troubled properties getting out of jail free kind of thing with, maybe interest rates changing or office building market coming back, or not really?
It's a complicated answer to your question. I think there will be a number of scenarios playing out. I think you're going to have, as very cheap debt matures over time, you'll have owners confronted with the dilemma what to do with that asset. And if they can't restructure it and typically do a pay down refinancing, they may be forced to sell at a level that's, either less than the value of the debt. So
yeah,
that will continue to play out over time.
And you had one of those properties in New York. You had a Madison Avenue that you guys sold at a relatively steep discount. Was that kind of fit into that parameter? You bought back in 2017 or something? Yeah,
I think the interesting thesis around that was that when you look at a Class B pre-war building, the cost to re-tenant them, mm-hmm. There you've got a building with 26 stories, single floor occupants. So every year you're doing 3 deals on average, and it just becomes this capital intensive asset.
Yeah. So how do you kind of pencil that out? I mean, like we were saying earlier, you're in 33 states. You've done $10 billion in deals. Like internally, obviously you want everyone to be a winner, but do you pencil out what percentage of deals or need to work out? I mean, how do you approach that?
You have to make a decision on a case by case basis. You have to do what's right for the asset, right for the investors, and that'll vary on a case by case basis, city by city.
Yeah, yeah. And John, I want to ask you a little bit more about WeWork and kind of the repositioning there. You mentioned, using, I think it was Four Seasons, right? Ritz-Carlton, close enough. Tell us a little bit more about, the vision there. Like, are you going to go a little bit more upscale? I know you were talking about trying to find a trophy property or a trophy property-esque building to make as a flagship. What's kind of your, some more thinking about the rebranding there?
I think there's an evolution of our product, the evolution of spaces. So when you look at the first and second generations of our spaces, we're now investing between $80 and $100 million to bring them up in what we call a refresh. But we're also, for the first time in the history of the company, looking at leases that are expiring. And now we're looking at moving closer to hubs, Grand Central or Penn Station. We've just done some deals by Penn Station. But we want to be in the right locations and really the right product. Now, we're not going to take a trophy that's $200 a foot. It's just not, it doesn't pencil out for us. But something that's a Class A product with great light and air and great views can work for us. So maybe it's just below on Park Avenue versus being up on the upside of Park Avenue. So we're looking at some of that. I think if you look at the new product we've done around the world, some of the just really great build outs. I just use San Francisco. We're in Salesforce Tower. Mm-hmm. On the 36, 37, 38 floors. It's arguably the best building in San Francisco. Right. That's our space.
Right. Because you usually think of WeWork as, Midtown South loft kind of thing going on. But Salesforce Tower is a departure from that.
And we have very similar product in many of the other countries around the world, many of the big cities. And we don't have it here in New York. We've got a great building downtown at 199 Water, but we need something in Midtown.
Yeah. And I want to also ask you about the financial picture for WeWork now. During the Adam Newman days, and I'm going to continue to make light of his tenure, they had something called community adjusted EBITDA, where it wasn't straight EBITDA. It was like EBITDA colored by the vibe of the workplace and adjusted up or down, correspondingly, I guess, if there was, if people were playing foosball that day or something. So it was like, how do you make sense of those financial numbers? And this is before they went public. You just had your first, what was it?
So, exiting bankruptcy, the restructure, we're debt free. We've got the cash on hand to invest in our people and in our product. And the last 2 quarters now have been EBITDA profitable based on GAAP.
Yeah.
Right. So no other different terminologies in there. Where cash flow is slightly negative, a couple $1 million the last quarter because we're investing in our properties. But that's going to turn the corner pretty soon. I think by the end of, 25, our target is the end of 26, but I think end of 25, we're going to see a good picture.
Yeah. And I want to ask you guys, because you were at Cushman for 47 years before you took the job at WeWork. Marianne, you've been at CBRE for a while now, running the show there. What was the toughest deal you guys competed on? I don't know if you've ever
That's a tough
gone down memory lane for this.
I'll throw one out.
Okay.
Because, especially with, we were talking out inside earlier, Pfizer.
Pfizer. Oh, it's true. I
Right.
lost Pfizer to them.
Well-
What a heartbreak is all I can say. And we saw Nathan Berman a moment ago, and all I can say is I knew it would never be an office building again.
That's right.
I think maybe my pessimism showed in the pitch. Yeah, that's
But I've been on the wrong end.
I'm sure.
And Marianne more than once, that's for sure.
And Richard, were you competing for that Pfizer deal?
No, we really focus on assets that are, call it, between 500 and 700 units in total.
Yeah.
We find that the exit liquidity, though, that scale is a little more robust.
And that's something like 1,600 units,
Yeah.
right?
Yeah.
That's a big one. And we're going to have Nathan Berman on the next panel who's doing that building. So he's going to talk about what he's seeing there.
But I'll just say that I think Midtown Grand Central needs that scale overnight to sort of begin the transformation that I think we all agree is going to be great for the Grand Central submarket.
Yeah. And do you want to just tell us lastly about your newest project, 77 Water? How does that pencil
Well,
out?
I would just say 1011 may be our newest one. It's thank you to Marianne.
Oh, say that again?
Yes, 1011 First Avenue is a deal we did.
Ah.
Yes, she made me pay more than I wanted to.
Well,
But we're active right now, both on 77 Water Street downtown, which will end up being about 590 units, 600 units
Yeah.
as we tweak it, and 1011 First Avenue.
okay. Has that been out there yet, 1011 First? I don't think I've seen it.
no.
Oops.
All right. We're breaking news today. We're breaking news. Well, I want to thank these guys for coming on stage today. Really interesting to get a take on the office market. Things are looking pretty good. It's pretty impressive how far we've come post-COVID. And thank you guys. Thank you all. Stay in your seat for the development panel next.